April 30th, 2025. A data terminal in London at the offices of the research firm Jato Dynamics. An analyst watches a spreadsheet update, and what shows up on the screen is about to rewrite the pecking order of the entire auto industry. For over a decade, if you wanted to name the company that owned the electric car market in Europe, there was only one answer worth giving: Tesla, not this month. The registrations tally shows a company from Shenzhen edging past it for the very first time. The margin is almost nothing. 66 cars. BYD had just outsold Elon Musk's company in one of Tesla's most important markets, by a gap smaller than a single school assembly. 18 months earlier, BYD had already dethroned Tesla globally to become the biggest electric vehicle seller on the planet. Warren Buffett, one of its earliest backers, had ridden the stock up more than 30 times over. Every chart, every headline pointed in the same direction: up. So how does a company on that kind of run end up a year later with its own chairman warning shareholders they've entered a brutal knockout stage? That's the part of this story nobody saw coming. Let's get into it. Zoom out for a second, because the 66 car story and the brutal knockout stage story are not two different companies. They are the same company, 18 months apart, and the space between them is where this video lives. BYD did not get unlucky. It did not get out-innovated by a smarter rival, and it was not swept aside by some sudden collapse in demand for electric cars. What happened to BYD is stranger, and honestly more useful to understand than a simple boom and bust story. The exact moves that took it from a domestic Chinese car maker to the largest electric vehicle seller on Earth are the same moves now cutting into its profit, its balance sheet, and its reputation. This is a story about a company that won so aggressively it started fighting itself. Today we're breaking down 4 things. First, the popular explanation for BYD's rough 2026 and why it's more comforting than it is accurate. Second, the real engine behind both the rise and the stumble. The price war BYD itself started, the financing trick that funded its expansion, and the quality control that struggled to keep pace with its own growth. Third, the cracks that opened along the way, including one very famous investor walking out the door for good. And finally, what BYD's story tells you about what happens when a company built for pure growth has to learn for the first time how to compete on trust instead of just speed. Because unstoppable, it turns out, was never really the right word for what was happening here. Here's the theory you'll find in most of the coverage of BYD's bad year, and it deserves a fair hearing before we pick it apart. The story goes like this. Electric vehicles were the hottest growth trade of the decade. The hype finally caught up with reality, and BYD, as the biggest EV maker of them all, was always going to take the hardest hit when the excitement cooled off. There is real evidence for this. China's new energy vehicle subsidies have been phased down. Consumer surveys through 2025 and into 2026 showed Chinese buyers growing more cautious about big purchases as the wider economy slowed. And BYD's own numbers gave the theory plenty of ammunition. January 2026, sales fell more than 30% year over year, the 5th straight month of decline, with production down almost 30% over the same stretch. Give the theory this much credit. It isn't lazy or dishonest. Slowing subsidies are real. A more cautious Chinese consumer is real. If you only looked at the domestic sales chart, cratering for months in a row, you'd be forgiven for concluding the entire EV growth story had simply run out of runway, and BYD was just the biggest name caught in the downdraft. Except, here's the problem. It doesn't explain the other half of BYD's own numbers, the half that was breaking records at the same time. In April of 2026, while domestic deliveries kept sliding, BYD's overseas shipments hit an all-time high, up roughly 70% year over year. If the EV story had genuinely gone cold, that number shouldn't exist. A company truly losing the world's confidence in electric cars does not simultaneously post its best export month ever. Something else is going on here, and it has almost nothing to do with whether people still want to buy EVs. So if it's not a demand collapse, what is it? Here's the honest answer, and it's a less comfortable one than the market turned, because it means BYD did a lot of this to itself. The real story is a price war BYD started, is still fighting, and cannot afford to lose, even though winning it keeps costing more than it's worth. Start with the scale of it. Research from the China Automobile Dealers Association calculated that the price war across the entire Chinese auto industry destroyed roughly 471 billion yuan in revenue between 2023 and 2025, close to $69 billion US. Average vehicle prices in China fell 11% over that stretch, from around 217,000 yuan down to about 194,000. And in BYD's own first quarter of 2026, net profit dropped 55% year over year to just 4 billion yuan, even as revenue held roughly steady. Translate that out of finance speak. BYD is selling almost as many cars in yuan terms as it was before. It is keeping dramatically less of each sale for itself. Here's the analogy that makes it click. Picture a marathon where the runner in first place decides the safest way to win isn't to run faster. It's to set a pace so brutal that everyone behind them collapses before the finish line. That works, right up until the leader's own legs give out first, because the body that set an unsustainable pace doesn't get to opt out of paying for it. BYD set that pace on purpose, back when it was still winning easily, and rivals were the ones gasping for air. 3 years later, it's the one paying the steepest price for the pace it chose, and the next 3 chapters are about exactly how that bill came due. Late in 2023, BYD's leadership called on the wider Chinese auto industry to band together and, in their words, take down the legacy giants of the global car market. It sounded like ambition. To rivals, it read like a declaration of war, and they responded like it was one. Great Wall Motor filed a formal complaint with Chinese regulators, alleging 2 of BYD's best-selling hybrid models failed to meet emission standards, a dispute that is technically still open. Then, in May of 2025, BYD cut prices on more than 20 models at once, with some discounts as steep as 34%. Its cheapest car, the tiny Seagull hatchback, dropped from around $10,000 to about $7,700. Rivals had no real choice but to follow. Great Wall's chairman, Wei Jianjun, went public comparing the state of the industry to Evergrande, the property giant whose collapse dragged down a huge chunk of China's construction sector, warning that an Evergrande-style crisis already existed in the car industry. It simply hadn't detonated yet. Geely's own vice president backed him up days later, citing Geely's own emissions testing. Give BYD its due here. The price cuts genuinely worked. They kept BYD the best-selling EV and NEV maker on the planet through a brutally crowded field of well over 100 domestic competitors, and they put electric cars within reach of buyers who otherwise couldn't have afforded one. But the honest cost is sitting right there in the Q1 2026 filing. Winning the volume war and protecting the profit margin turned out to be mutually exclusive goals, and BYD chose volume, quarter after quarter, until the margin nearly disappeared. That decision is still only half the story, because the price war wasn't the only lever BYD pulled to fund its rise. The second engine behind BYD's rise is quieter than a price war, but arguably more important, and it's the one most viewers outside China have never heard of. For years, BYD paid a large share of its suppliers not in cash, but in company-issued I owe us, informal notes that suppliers could hold, trade, or cash in later, often after waiting well over 100 days. It is in effect an interest-free loan from BYD's own supply chain, funding expansion without touching the balance sheet. For a company scaling as fast as BYD was, that float was rocket fuel. It let BYD build factories, undercut rivals on price, and push into new markets, all while keeping its books looking remarkably clean. For 4 straight years, BYD actually ran with negative net debt, an almost unheard-of position for a manufacturer growing this fast. But Beijing started leaning on the practice, worried it was quietly squeezing the small and mid-sized suppliers who make up the bulk of China's auto parts industry, and BYD began shifting toward paying suppliers on ordinary, interest-bearing debt instead. Here's the number that tells you what that shift is costing. BYD's net debt-to-equity ratio has climbed to 25%, a sharp reversal after 4 years spent firmly in the black. Quick pause. If you're finding this useful, consider subscribing. It genuinely helps a channel like this keep going. And I'm curious, if you were running a supply chain the size of BYD's, would you rather protect your suppliers or protect your own balance sheet? Drop your answer below. I read every one. Because the float that funded BYD's expansion is unwinding at the exact moment its price war is compressing margins from the other direction, and that combination is squeezing the company from both sides of its own balance sheet at once. The third pressure point is the hardest one for BYD to spin, because it isn't about macro forces or industry politics. It's about whether the cars themselves hold up. Growing this fast meant BYD needed factories, suppliers, and assembly lines to scale at a pace almost no automaker in history has matched, and the strain is starting to show. In October of 2025, BYD issued its largest recall to date, over 115,000 vehicles covering Tang SUVs with a motor controller flaw that could cause a total loss of power, and Wenpro EVs with battery seals installed badly enough to let water in. Barely a month later, in November, BYD recalled almost 89,000 more plug-in hybrids over inconsistent battery pack manufacturing. And underneath the official recall filings, a steadier stream of complaints has been building online, with Chinese owners posting videos of interior panels that turned out to be plastic dressed up to look sturdier, describing gaps stuffed with foam instead of proper insulation. To be fair to BYD, none of this is unique to one company. China's own regulators have flagged battery and drivetrain defects as the leading cause of new energy vehicle recalls industry-wide, and BYD has moved to fix the issues at no cost to owners, including over-the-air software patches that flag battery anomalies before they turn dangerous. But recalls and viral complaint videos do something a price war alone can't. They chip away at the one thing BYD spent 2 decades building: the sense that its cars, even the cheap ones, could be trusted the same way a much pricier badge might be. A shopper choosing BYD over a legacy brand was betting that the discount didn't mean a compromise, and every recall notice makes that bet a little harder to place with confidence. And trust was about to take one more very public hit, from a name nobody expected to be involved. That hit had a name a lot of BYD's fans didn't expect: Warren Buffett. Berkshire Hathaway first bought into BYD back in 2008, at Charlie Munger's urging, spending $230 million for a 10% stake when the company was still a scrappy battery maker most Western investors had never heard of. That stake eventually grew more than 30-fold, turning into one of Munger's proudest calls of his career. Berkshire began quietly trimming shares back in 2022, but by the middle of 2025, regulatory filings confirmed something that would have seemed unthinkable a few years earlier. Berkshire's stake in BYD had fallen all the way to zero. 17 years later, Buffett was out completely, right as BYD's own half-year report described its market as caught in excessive marketing and intense price competition. This is where the abstract turns personal, and not just for a famous investor in Omaha. At a used car lot in Beijing, a salesman named Ma Hui described the mood among his fellow dealers in blunt terms, saying everyone he knew in the trade lost money the previous year, squeezed by falling resale values as the price war dragged used prices down with it. Multiply Ma Hui by the tens of thousands of dealers, suppliers, and factory workers whose livelihoods sit downstream of BYD's pricing decisions, and you start to see the real cost of a strategy built on scale over sustainability. BYD didn't just start a price war against Great Wall and Geely, it started one that eventually pulled in everyone standing anywhere near the Chinese auto industry, right down to an ordinary man trying to sell used cars out of a lot in Beijing. So is BYD actually in trouble? Or is this just noise around a company that's still winning? Here's the honest scoreboard. Both sides argued fairly. On one side, the optimistic case is real and backed by real numbers. BYD is still the largest EV and NEV maker on the planet by volume. Its overseas shipments hit a record high in April 2026, up around 70% year over year, and the UK became its largest market outside China, with sales up more than 800% through September. Its flash charging network, delivering up to 1,500 kilowatts, roughly 3 times a Tesla supercharger, is expanding fast through a partnership with Sinopec's 30,000 fuel stations. Its God's Eye driver assistance software, offered free on models that used to charge extra for it, is rolling out across Europe next, giving BYD a feature Western rivals still treat as a premium upsell. Goldman Sachs looked at those same Q1 2026 numbers everyone else panicked over and called it the likely trough, expecting gradual recovery through the rest of the year. On the other side, the skeptic case is just as real. BNP Paribas rates the stock an underperformer, flagging that a domestic margin recovery is anything but guaranteed. The company's own European factory, meant to be a symbol of its next growth chapter, just got pushed back a full year to the fourth quarter of 2026. Profit fell 55% in a single quarter. Recalls keep mounting. So the honest answer isn't that BYD is collapsing, and it isn't that everything is fine either. It's that the version of BYD that could grow without consequence, discount without limit, and expand without scrutiny, that version is gone. What's left is a very large, very capable company that now has to compete the hard way, like everyone else. Strip BYD's name out of this story and you're left with lessons that apply well beyond one Chinese car maker. 1. The exact tactic that wins you market share can, if you can't turn it off, become the tactic that destroys the margin needed to sustain that share. 2. Financing your growth off the back of your own supply chain works beautifully right up until regulators or your suppliers decide it doesn't, and by then the bill has usually gotten bigger, not smaller. 3. Growing faster than your quality control can keep pace with is a debt that eventually comes due, usually as a recall notice or a viral video, not a headline of your own choosing. 4. Even the most loyal, longest-tenured investor will walk away the moment the math stops working, no matter how good the story used to be. And 5. Global expansion can genuinely mask domestic weakness for a while, but eventually both get priced in at the same time. Here's the one-line verdict. BYD didn't lose the electric vehicle race. It's still out front. What it lost was the version of winning that cost nothing, and now it has to win the much harder way. One car, one supplier, and one recall at a time. If you want more on how this same price war is reshaping the rest of the industry, check out our breakdown of BMW bet everything on China. China just walked away, which covers what happens to a legacy automaker caught in the same fight from the other side, and everyone laughed at BYD. Now they're buying Mercedes, which digs into how BYD clawed its way into markets nobody thought it could touch. And here's a question I'd genuinely like to hear your answer to. If you were BYD's chairman right now, would you keep fighting the price war another year, or call a truce first? Let me know in the comments. I read everyone. Thanks for watching, and I'll see you in the next one.